All right, everybody. Well, hey, hope you are all doing this well on a Monday night. Welcome to Note Night in America. Honored to be here with you guys. This is, I think, the 104th, 105th Note Night in America that we've had in the last couple of years. So honored to have on a special Monday night. Obviously, May the 4th be with you. May the Force be with you. Definitely here tonight because we've got some great stuff we're going to talk. I'm really excited to have this guest on here. He's got some big things going on. And I had him on my podcast, I don't know, a month and a half ago, and was so blown away by what he is doing out there. But I'll save the thunder for just a second. I got to cover a little housekeeping rules before we bring on the man, the myth, the legend here, Mr. Brett Swarts here from the Capital Gains Tax Solution Podcast. So just want to go through a little bit of housekeeping with you guys all out there. We've got a couple of big events coming up here. Obviously, Note Night in America, if this is your first time to join us, we are honored to have you. We do record these. I do see the red light record is on. They are recorded. You can always go to weclosenotes.tv. They'll take you to our YouTube channel for you to be able to watch all of our videos, over 1,000 videos on YouTube. Make sure if you're going to YouTube, you hit the subscribe button so you're aware of everything we post up there. Not only Note Night in America episodes, but also our Note Closer Show podcast out there. Note Night in America podcast hit a milestone this last month, over 75,000 downloads from the one little podcast that we do, a couple times a month. We're pretty excited about that. As always, you can go to weclosenotes.com to check out everything going on there. But we do have something cool going on this Wednesday afternoon from 1 to 5. I'll be calling bank asset managers for 4 hours. Calling special asset managers, calling whole loan trading departments from 1 to 5 p.m. We'll be doing it via Zoom. We'll do live Q&A for those that are paid to be part of it. If you've already picked up a ticket to Note Camp in June, you get a ticket. If you picked up a ticket to our virtual workshop in 2 weeks, this is included. If not, and you just want to listen in and watch and ask questions, you can do that for just $49 by going to callingbanks.com. But if you want to really get a bang for your buck, sign up for one of the other two things, and this will be comped in as an extra bonus for you. So 4 hours of me making phone calls and asset managers. I have an email going out first thing tomorrow morning to my list of asset managers, and we'll be calling off of those that have clicked on the link as a double way. There's another way to make that contact with them. But two big events over the next 30 days you don't want to miss out on. Our virtual note buying workshop, our 3-day workshop is back. First time we've taught it this year, and was going to do it a little bit in March and decided to hold off to see where the market was going, but got some great stuff. May 15th to 17th, normal cost is $6.99. We dropped it down to $5.99. Go to notebuyingfordummies.com or go to weclosenotes.com and check out the virtual workshop. Click there. If you sign up for that, you get a ticket to the next event in June. Otherwise, we got Note Camp 2020, which I'm honored our speaker is one of the keynotes on there as well. June 5th through the 7th, that's a 3-day online note convention. It's $99 for a ticket that ends tomorrow, actually. Ends tomorrow, Cinco de Mayo. It'll go up from there, so get your extra early bird price. Like I said, sign up for the virtual note buying workshop, and you'll get a ticket thrown in as an extra bonus for you out there. But we are 31 days out from Note Camp 2020. But anyway, after that's all the updates we need on that stuff. Any questions about those events before we bring on our special guest expert tonight, which are really I'm pretty excited about. I think he's going to be getting a lot of usage of what he's sharing tonight. And what he does and his expertise out there. But if not any questions, we are honored to have Brett Swarts from the Capital Gains Tax Solution Podcast out there. This guy is a commercial realtor and an investor who is doing some big things out there, amazing things. And so, Brett, we are so honored to have you here. You are also, today's the official launch date for the podcast as well. Congratulations. We'll make sure to put a link in there for everybody to go on there and listen to his episodes. Subscribe, leave a 5-star review. Already got all that stuff done today for you. But Brett, we are so honored to have you here on Note Night in America tonight.
Scott, thank you so much. And I am thrilled to be with you and add some value to your audience right now.
Well, good, man. How's everything going out there? You're out in California. You're near Sacramento State Capitol, aren't you?
Absolutely. It's great out here. We're about 75 and breezy, and we are on lockdown. But we are grateful for every day that we have to count our blessings. And we launched a huge podcast today. So exciting. You were a big part of that, Scott, being in your mass media mastermind and getting the chance to just get the inspiration and the knowledge, the wisdom to get everything together, right? It takes a whole team. So we are really, really, really excited for that launch.
Yeah, and I'm honored. I was listening to some of the episodes outside on the patio in the afternoon today, taking a little bit of a breather to listen to a few of them, and you got some great stuff on there. But I'm going to give it over to you now. Do you want people? I know you said you got a little bit of a presentation you want to go through, kind of helping people outline the concept you're going. Do you want to wait and answer questions at the very end, or you want me to interject in if they're appropriate, or just wait to the end? What would you like?
No, you can jump in with clarifying questions. I actually prefer that more of that dialogue as we go, and you think there's something that you want to specify or dive into for your audience, you do that. Feel free to jump in.
Cool. So I think you want to share your PowerPoint pulled up to share your screen, right?
Here we go.
Oh, look at you. You're an old hat on that. Perfect. Well, I'm going to drop off camera. I'll still be here in the background because I'll be jumping back and forth between the questions here and then also the live stream on Facebook as well too. Okay, Brett?
Perfect. Beautiful. Thank you. All right, everybody. Thank you so much. I am Brett Swarts, Capital Gains Tax Solutions. I'm here in Northern California, and this presentation is titled How I Helped Dave to Finally Achieve Relief from Retirement when he sold a $7.6 million multifamily building and saved $1.1 million in capital gains tax without having to do a 1031 exchange. In fact, we saved his failed 1031 exchange. And yes, you can do that. And we're going to show you how right now. So that's me. And legal disclaimer quickly, I am not a CPA nor your tax professional. Every single thing, every single deal is a little bit different, and your circumstances will vary widely, and we strongly encourage to seek independent legal and tax professional advice. Now, Dave was in your position just about 1 year ago, and he was looking at this deferred sales trust for the first time. By the way, not to be confused with the Delaware statutory trust, which is just another form of a 1031 exchange. And he had never heard of this thing, and he's going, what is this thing called a deferred sales trust? Well, first of all, a deferred sales trust is just a manufactured installment sale. If you're in the note business, along with Scott, you know it as a seller carryback or a land contract, where you as the seller of something can become the bank or the lender and carry paper in order to defer capital gains tax, okay? But we do a specialized installment sale, and this is what Dave was learning about for the first time. And so really what he was wanting to do, and this might resonate with you, he wanted to be able to basically sit on the sidelines, to be able to time the real estate market, right? We all know as real estate professionals and as owners of real estate that we make our money on the buy side, right? Buying low and selling high, right? And so he said, look, I don't want to buy in this overpriced market. I want to buy when it's a buyer's market, right? I'd rather wait on the sidelines and wait for something like a Corona crash or economic crisis, or just something where it's just more reasonable where I can find a deal, rather than overpaying via a 1031 exchange just to defer the tax. Also, he's a baby boomer, and he wants to sort of slow down a little bit too right now. He wants to retire from the toilets, the trash, the liability, and he wants to trade them for time, liquidity, travel, diversification. He's part of what's called the largest wealth transfer in the history of the planet, which is going on right now, which is this. According to the American Bankers Association, about $17 to $20 trillion will pass from one generation, the baby boomers, to the next generation in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. In fact, there's about 77 million baby boomers in the US alone, and about 10,000 are turning 65 every single day. And they've made this massive amount of wealth with businesses, with commercial real estate, with high-end primary homes, with artwork, with collectibles. And they're looking at all of these toilets, trash, and liability, and they're saying, how do I get out of this without getting completely clobbered and hammered by a 30 to 50% in capital gains tax? And or how do I sell something and not have to overpay? And so that's what we're going to cover in this presentation, and these 3 secrets to an optimal timing wealth plan. But in the meantime, Dave, for example, he's planning on just sitting on the sidelines. In fact, he's sitting right now with his funds at TD Ameritrade and just waiting for the deals to come in. He's completely diversified. He's on the sidelines, and he's going to wait and be patient with this, which is really, really what this allows you to do versus the 1031. So by the way, who is this for? Well, this is for anyone who's listening to this presentation who has a highly appreciated business, investment real estate, primary home, or other asset that's subject to capital gains tax. What other asset? Well, it could be Bitcoin. It could be carried interest. It could be captive insurance. It could be artwork, collectibles. I'm doing a horse deal right now in Kentucky. If you ever watched the Kentucky Derby, well, those horses are worth a lot of money. Well, guess what? If you buy that horse at $1 million and you sell them for $3 million, that's a capital gains tax. You're going to owe taxes on that, right? And that could be somewhere between 30 and 50% of the gain. That's a big chunk. So you need to be selling something worth at least $1 million approximately, net of all debt. And the asset needs to have a gain, a capital gain of more than $500,000. So if you hit those parameters, it works, okay? And or maybe you're a real estate professional. Maybe you're a financial advisor, a business broker, a commercial real estate operator, syndicator, and you have your partners or clients who are dealing with these same challenges, okay? So what is a deferred sales trust? Again, we touched on it earlier. It's a manufactured installment sale. We're gonna walk through how that all works. But the key is, why would you need one for your wealth plan? Well, I want you to think about two things. And the first one is Blockbuster. Do you remember the days when you went into Blockbuster? I'm a 1980s kid. And growing up, Blockbuster on Friday and Saturday nights, either in video games or movies, was like the best thing, right? I had no idea Blockbuster was going to go out of business, right? We thought it was the best kept thing. Well, Netflix came around, and I don't know if you know this, but Netflix actually approached Blockbuster and said, "Hey, will you buy our business for $50 million? We have this new thing." And they're like, "You know what? We're good. We'll make our own version of that. We've been doing this for a long time. Thanks for the offer, but we're good." And they didn't. And as you know, the old is gone and the new is here. So Blockbuster is now, bankrupt, and Netflix is one of the largest media companies in the world. But there's an old way of doing things and there's a new way, right? And we like to say the old way is sort of like doing the 1031 exchanges. And by the way, the 1031 exchange, guess what? It only works for investment real estate. It doesn't work for your high-end primary home. It doesn't work for a business. It doesn't work for it actually will work for carried interest, but it doesn't work for artwork or collectibles. It doesn't work for Bitcoin. It doesn't work for horses. It doesn't work for anything that's basically besides investment real estate. It doesn't work for. Whereas the deferred sales trust, the new way, it works for all of those asset classes, which is a great thing. But the key thing I want you to think about is things have changed, and how might you look at this wealth presentation change your perspective on how you invest and how you time the real estate market, okay? So for my goal for this masterclass is, number one, I want at the end of this masterclass for you to say the only way for you to gain the most freedom from capital gains tax is through a deferred sales trust optimal timing wealth plan. And number two, the only way to an optimal timing wealth plan is through capital gains tax solutions. And I'll ask for your commitment now that when you know that a deferred sales trust fits 1 and 2 and is the best way for you to move forward for a deal that you're selling, that you will go all in and you will commit to being educated and getting your CPA on board, getting your financial advisor on board, and essentially grabbing hold of this tool and then using it when your deal comes up, right? So I want you to take the information essentially and then get equipped with it, and then go to your trusted advisor who you'll need their approval, and have it as your tool for when you go to sell as an option for your deferring your tax. Although I think most of the time it's your number one option, but that's for you to decide based upon what you see coming up here. So as a real quick background, I started at a company called Marcus and Millichap. It's one of the largest investment real estate brokerage firms in the nation, specializing in investment real estate. Help people sell around $88 million in multifamily, retail, office, land, commercial real estate syndications of over 100 million of senior housing, mixed use. I'm a real estate investor myself, commercial real estate by trade as a broker. And I've closed countless 1031 exchanges, Delaware Statutory Trust, Deferred Sales Trust. I also happen to have my series 22 and 63. I speak all over the country now and on podcasts and conferences, and I educate everyone on capital gains tax deferral. I've been on some big shows, including Scott's show. By the way, Scott's show is dropping on Wednesday. He's a part of the exclusive launch week, and I put him on his own day to promote him on Wednesday versus the rest of the folks. So you're going to look out for that show. But I've been on a bunch of other shows as well. You might recognize a few of these folks. That being said, this is one of my favorite ones. Seth Green, he's pretty cool, and he's connected with Kevin Harrington. I was on their Sharkpreneur podcast, which is great. But let's start with my story. So I started out at a company called Marcus & Millichap, and my first year in the business, this was not me. In fact, this was my cousin. So I came out of college, and basically we're all on the phones. We're all calling investors, and we're trying to get them to do deals. I came in right at the end of 2006 when I started, and I actually didn't graduate college to July of 2007, but I trained for about a year and got my license, and I was jumping on phones, but it was very challenging. I mean, I was a new to the business. I also was newly married, And I was just a dad trying to provide for a family at home. I had my new daughter at home, and my wife and I were struggling financially. In fact, she wanted to be a full-time mom, and I wanted to be the dad who provided. And growing up, my parents, we didn't have a lot of money growing up. Well, at least my dad did. My mom didn't. Parents were divorced. And so it was a challenge always financially on my mom's side. And so I knew financially I wanted to be that dad who provided, and I wanted to make sure I had margin for the family. But it was really hard. I mean, I was competing against these big time brokers, and I was just starting to get traction. And I was starting to get success. And they said in the business it's going to take a little while to get going. But something happened right as I started to get some momentum, and that was the 2008 crash. And if you recall, things really fell apart economically in that time period. And so I went from making just a little bit of money to like zero money real fast, right? So there was years where I made next to zero. Some years I made like 20 grand, and I'm just trying to, so trying to make it all work, right? With my family, keep my dream alive. And I have friends and family tell me, go get a real job. What are you doing? You have a wife at home and a baby, what are you doing? Well, I did what every good entrepreneur does. And I figured out a way to get side jobs, and I worked nights and weekends at a restaurant. You may know it, called as the Cheesecake Factory. In fact, it was my wife and I's favorite restaurant. And this is actually my manager right here, who's smiling with the tie on. And that's not me in the background, although he kind of looks like me. But this is exactly where I worked in Sacramento, Roseville, California, helping people serve cheesecake. So by day, I'd be on the phones, and by night, I'd be serving cheesecake. And there'd be times where I'd have to like dodge potential clients who were in the other part of the restaurant, because I was calling them by day to try to sell their $1 million property, but I was serving cheesecake at night. So it was a humbling experience, but also a big part of my journey to persevere and really define what I loved. I just fell in love with commercial real estate, helping people defer capital gains tax, and helping them solve their plans. So my goal was to win. And this was not me. I was not winning. And essentially, I found the Deferred Sales Trust right at that ideal moment. Essentially 2009, it wasn't ideal for my clients because they had crashed, but it was ideal for me to receive the information, and that people didn't have to overpay for property. They didn't have to go into a bunch of debt. They could have actually avoided a lot of the pain they went through. So not only was I in a struggle personally, but my clients, friends, and family, some of them lost everything because they felt they had to overpay for with 1031. And so as a quick reminder, a 1031 exchange essentially is you buy a property, and if you sell it, you can trade it to a like-kind investment property as long as you identify within 45 days and then close within 180. And that way you defer the capital gains tax. But that's all we knew before, right? We didn't know about the Deferred Sales Trust, where you don't have to do any of that. You can sell, put it in the trust, and you can buy whenever you want to. And also you don't have to take on any debt. And so I learned all about this, and I was able to succeed in my business, provide, and by the way, the plan was to educate my clients, and then it led to educating more people, which we're doing now. But I was able to provide, we now have 5 kids. We had 4 girls, and we had our baby boy here recently. And I was able to succeed. And basically what I want to do is I want to take these last 10 years of the pain and the struggle and the journey. And I discovered the hard way to do it. But how many of you want to learn the easy way to do it? The easy way to essentially eliminating the need for the 1031 exchange and having more options. So hopefully that's a yes. I know I can't hear you, but maybe you can put that in the chat. I love that. So if you've been struggling, this is probably why. You've probably been struggling because A, you didn't know about it, right? And it's not your fault. Your CPA didn't know about it either, right? And by the way, the commercial real estate brokers you work with and the 1031 exchange companies you work with, they don't want you to know about it either, right? And they're in the business of the 1031 exchange. They want you to sell and buy a bigger property and sell and buy a bigger property and just keep chasing that equal or greater value within the 180 days because every time they get paid. Trust me, I know. I was in that business. And I'm not saying that a 1031 is not useful. It absolutely is a great way to build wealth, but it has some restrictions and it has some challenges which are not always in your favor, right? And so if you tried to do a traditional 1031 exchange and you've ever felt pressured by having to overpay, or you bought a property just to defer the tax, the Deferred Sales Trust is for you. By the way, we call that buying at non-optimal timing, right? Our parents taught us to sell high and buy low. not sell high and buy 180 days later from now, right? That's the opposite of freedom. That's restriction and that's pressure. And so what we want to do is give you the Deferred Sales Trust tool so that you can relieve all that pressure and you can have the freedom and liberty to buy if and when you want to in the asset type that you want to, hopefully at a discount when it's a buyer's market, okay? So let's talk about the 1031 for a second again. What we've been forced to do for the past 10 years. You got to hire a broker, 5 to 6% commission to sell your property. You got to sell your property, additional closing costs. You got to hire attorneys to review documents. You got to hire a 1031 qualified intermediary. Probably got to hire another attorney to draft a new LLC document for the new property. You got to identify those 3 properties in 45 days, 180 days to close. It creates pressure. You got to obtain a loan. You got to apply for a loan. You got closing costs. You got to buy a property. Hopefully you didn't overpay. You got to take on more debt than you want it to, feeling more pressure. And just an upfront cost, it could be hundreds of thousands of dollars per deal, depending on the size of the deal. Plus, you only have 6 months to sell and buy a property. One of the things with the Deferred Sales Trust is you never have to buy a property ever again to defer the tax. In fact, you could just put it all into stocks, bonds, and mutual funds, or you could put it into hard money lending with Scott, and he could help run the money. It's very flexible and very open. It doesn't have to be you by yourself owning, operating, managing all of the toilets, trash, and liability. It's exhausting for even just talking about it. That's what we give you as a way out here, okay? So really, it's just the endless amount of work that is that's dealing with owning real estate, and you should have an option out, and we believe this is what we give you. So in the next 30 minutes, I'm going to walk you through how to build an entire optimal timing wealth plan, and so here we go. So the 3 secrets to an optimal timing wealth plan. All right, secret number 1. Selling and deferring hundreds of thousands to millions of dollars in capital gains tax. How to legally break free from capital gains tax and find freedom to buy and sell your business or property without ever worrying about a 1031 exchange ever again. Secret number 2, optimal timing wealth plan cloning, okay? So how to clone a proven wealth plan with capital gains tax solutions in less than 5 hours and become a lender, because this is what you're becoming in this, that does not actually give up control. And I say, well, almost, and we'll walk through some of that. And number 3, my number 1 wealth building hack, how to get your deferred sales trust to work in your favor and become an investment rather than an expense. Okay, so secret number 1 is how to legally break free from capital gains tax and find freedom to buy and sell your business or property without ever worrying about a 1031 exchange ever again. Okay, so meet Joe. Okay, so Joe wants to sell his business or primary home or commercial real estate, but he feels trapped. What's he trapped by? Well, he's trapped by that 30 to 50% in capital gains tax. He's also trapped by the 1031 exchange or lack thereof option to when he sells his assets, okay? So let's just talk about the 1031 for a second because we're focusing on commercial real estate. If he buys something, sometimes it really hurts to overpay. He's feeling pressured. He doesn't want to necessarily take on more responsibility, more debt, more tenants, more trash, more everything. So that's when he kind of gets the black eye and he feels frustrated. And too often his story is a sad face story, meaning he wants to retire. He wants to be out of debt. He wants to have a passive income stream. But guess what? He has to 1031 to defer the tax. So he feels trapped. So he doesn't want to have to repeat this process over and over and over again with the next property. But that's what he's done for 20, 30, 40 years. And this is all he knows. And maybe this is all you know. But there is a better way, okay? And this is step number 1 for you. You first of all have to determine your capital gains tax liability. What is your liability if you sell? And by the way, we have a deferred sales trust calculator, capital gains tax calculator on our website, capitalgainstaxsolutions.com, where you can fill in 12 questions and you'll get it instantaneously. But more than that, you need to determine your ideal wealth plan. You need to envision what your wealth plan looks like in 1 year, 5 years, 10 years. You need to look at your overall estate and how you want to pass your wealth to another legacy and how you want to spend your time and energy with all of this wealth. Most of our clients, before they find us, they've already made their wealth, right? They've already achieved great success. And now it's about shifting that wealth in a way that gives them a passive lifestyle, that gives them diversification, that gets them out of debt, that lowers their risk, and also gives them the time and energy to enjoy their wealth. So I want you to envision your ideal wealth plan and what that looks like. And I want you to write that down and look at that. And that leads into step number 2. I want you to look at what tool is going to help you to get to your Envision wealth plan, okay? And you look at the side-by-side comparison of a 1031 exchange or a deferred sales trust. and you put a line down the middle and you said, if I do a 1031, what does that mean? Well, that means I'm owning real estate. Okay. Well, you might like to do that. And I like that too, but maybe that means you're owning real estate by yourself, which oftentimes is the case. You're dealing with the toilets, the trash, the liability. You're also not diversified. You're in a single asset class or a single asset inside one place. Oftentimes, a lot of clients are just selling one, let's say 20 unit apartment complex, and they're buying a 50 unit. So they went from 20 problems to 50 problems. Okay. And they're having to deal with all of that. Well, why not do it in the deferred sales trust and either A, not buy any real estate at all, or just take small amounts, maybe 500,000, and put it into a syndication over here. Let's imagine it was a $3 million deal. Our average deal is 2.9 million. We're deferring some around $500,000 in tax, but you can take small portions of your equity and put it into multiple different ones. So you're diversifying within commercial real estate. You're also not having to deal with all the toilets, trash, and liability. You're also not having to have the debt in your name. Now you can, of course, buy your own properties if you want to through your trust. It's kind of like a self-directed IRA in that sense. So you have you have all the options that the 1031 gives you, but also you have none of the restrictions. So none of the timing restrictions, none of the debt replacement. So you want to draw that down the middle, and you want to look at side by side and what helps you to get there. Okay. That's step number 2. Step number 3, you want to talk with somebody who has actually successfully used the deferred sales trust. And this is where we give you access to our clients who have closed it. By the way, track record real fast, thousands of closes over 24 years, 14 no change IRS audits, and you name it, it's been closed. Dental practices, optometrists, veterinarians, car dealerships, multifamily property, self-storage. We're working on a Bitcoin case right now. We've done helicopters, private property, high-end cars, artwork, collectibles. So you want to talk with somebody who's sort of been in your shoes, right? Who's owned commercial real estate, or maybe was a veterinarian or whatever, right? We'll connect you with those folks so you can talk with them and get comfortable with that as well, and to see if it's a good fit. Step number 4 is just to sell your deal. Sell your deal and fund the deferred sales trust. By the way, where are the funds held? TD Ameritrade is one of the banks we use, the largest bank in the world. And you have 24/7 access to view the funds, and the funds never move without your signature. So they're always protected and always safe, and only move with your signature. So let's circle back with Dave here. Remember Dave? Dave was in your position 1 year ago, and he wanted to be retired. He wanted to sit on the sidelines. He wanted to have options. He wanted to have freedom. He wanted to have liquidity. He wanted to be out of debt. And so he sold a $7.6 million property, and essentially $3.1 million was sitting in with a 1031 qualified intermediary. And essentially COVID-19 hit. And when it hit, he said, oh my gosh, I didn't want to buy before because the prices were high. Now I'm completely freaked out. I don't want to buy anything right now because who knows where this market's going. And so for the first time, he used the deferred sales trust. And his biggest thing was, with the 1031, again, you have to replace equal or greater debt. So 7.6 million is what he sold. He's going to have to buy something for 7.6 million or greater. So he's looking at $8 and $9 million deals. Let me ask you a question. Do you want to go into debt in a highly appreciated, uncertain market? The answer is no. The 1031 forces you to do that. To get 100% tax deferral, you have to buy at equal or greater value. So he owed about 4.5 million in debt. And so instead of doing that, he got out of debt. He's debt free from all of his property, and he put all the funds into the trust. So one side of the deferred sales trust is, do you want to be debt free? Back to the envisioning your ideal wealth plan. Do you want to be out of debt or in debt? Well, I would say most of you would probably want to be out of debt right now, which I would agree. Be out of debt is a great time to be out of debt right now. Go into debt when it makes sense. And so he's out of debt. And then do you want to be on the sidelines, or do you want to be in the game right now? Well, I think you probably want to be on the sidelines, and so did he. So he's waiting for the deals to shift. Do you want to be diversified, or do you want to be all in on one deal? Well, he wanted to be diversified. He's going to put it into some hard money lending. He's going to wait for real estate. He's also going to put it in some stocks while he can buy them low. And so this was his wealth plan. This is how he envisioned it. And by the way, on YouTube, you can hear his whole story. If you go there now and just search Capital Gains Tax Solutions, and you can see Dave's story. He just posted just a few weeks ago, and he tells it all while I interview him on the podcast. So how does this all work? Scott, you ready to interact with me a little bit?
Yes, sir.
All right. So we've got, we're going to use Dave's deal, okay, as the sample here.
Yeah.
It was a $7.6 million deal, and we're dealing with this number up here, 1.1 million in tax, okay? So if Dave does nothing, he was going to pay 1.1 million in tax. So he had this apartment complex to sell, okay? And it was a 128 units. So he had a buyer all ready to go for 7.6 million. But guess what, Scott? The idea of actual or constructive receipt is the most important thing here, okay? When you actually receive the funds is when the tax is due. So Scott, imagine I was going to buy your $7.6 million property, which is say it's your deal. Let's imagine you were free and clear, Scott. And so Scott, if I came to you and I gave you $1 million down payment and I asked you to carry a note for 6.6 million, how much actual receipt, Scott, did you receive?
I only received 1.1 or whatever.
Yeah, 1 million, right? Whatever down payment I gave to you is what your actual receipt, right? So the tax is triggered on that. And the other 6.6 would be, you'd be carrying paper and you wouldn't owe tax on that until I paid you back. Does that make sense?
Yes, it does.
Okay. Now imagine, Scott, I gave you a 0 down payment. I said, Scott, would you carry back 100% financing? So Scott, if I gave you a 0 down payment for 7.6, 0 down payment, and you carried a note for 7.6 million, how much actual receipt did you receive today?
Go back through that one more time.
If I give you a 0 down payment, how much of a down payment or how much actual receipt did you receive? You got it. So you just carried 100% financing. Now in real life, you wouldn't do that because I have no skin in the game, right? And I may wreck your property. You're not diversified. You might have to take it back. Like it's just not that's why most people don't do traditional seller carries, honestly, because they're typically short in nature and too many other challenges. But the law makes sense, or the legal part makes sense, is that actual receipt hasn't been received. Okay, so that's how we maintain constructive or actual receipt. So let's walk through how we do it here. So if they were to give the buyer that 7.6, guess what? He would owe that 1.1 million in tax. So we don't want that money to go directly to him. He says, no, I don't want to do that. Rather, let's sell it to this trust right before close of escrow. And he's going to sell it for 7.6. And the trust is going to turn around immediately and sell it for 7.6, Scott. Now, Scott, if the trust bought and sold for the same price, how much gain does the trust have?
0.
You got it. So if it has 0 gain, it has 0 tax, okay? Now, over here, they carried a note for 7.6 million, and they received, it's a note here, okay? They received a 0 down payment. So again, Scott, if they received a 0 down payment, how much tax is triggered today?
0.
You got it. Okay. So the funds get deposited into the trust, 7.6 million. Now they had debt on this property. So it ended up being 3.1 million. They're going to pay off the note to the bank. And this is actually going to be 3.1 to keep it consistent with the deal. Okay. But the point is, he's in a deferral state. They just did 100% carryback. They just did a land contract, 100% financing, okay? The question is, why would they do that? We're going to get into that. But Scott, any questions on what just happened here?
No, I think it's pretty straightforward. It's just you're creating an entity that's technically buying it for the same price you're selling it for. So there's no, it's just a separate entity that's handling that for you for the most part initially, correct?
Correct. It's just a business trust. It's a single entity business trust that only does business with the client, but essentially it buys it for the same price that you were selling it for and immediately turns around and sells it to that buyer for the same price. Because it bought and sold for the same price, it has a 0 gain. And Scott, since you did 100% carryback, or this person did, it has no tax that's triggered today. It's in a deferral state.
Makes sense?
Yep. Okay. So that is how it works. It's actually that simple. Okay. Now it's new to you and you're like, I don't quite follow everything exactly. And that's okay. We'll walk you through it, but it's really just an installment sale. And we add this third-party trust to make this work. Now, the funds in the trust, TD Ameritrade, Bank of New York Mellon, Charles Schwab, they only move with your signature. Once they're in the trust, this is where the magic happens here. Now, in this one, it's 3.1 million. Guess what? First of all, they're debt-free, no debt. That's fantastic. Doesn't have to replace anything. But now he can buy whenever he wants. So we call that optimal timing, okay? Optimal timing. He can also invest into hard money lending, right? We'll call it notes. He could put
So are
it
we
in.
saying the trust is, let's clarify this. When you say he, are we talking about it as actually the trust that's signing off on that?
So this lender is the chairman of the bank. Okay. So they have just become the lender. So they are always approving or disapproving of the investments based upon the risk tolerance. That's a great question. So before anything moves, anything closes, the note holder fills out a risk tolerance questionnaire. Based upon that, a score, they get a score. Based upon that score, they're determining a level of rate of return. Most of our notes are 8%. Okay. And they're typically over a 10-year period of time. And you can renew every 10 years for 10 years and pass it on to your kids. It can go on forever. Okay. And we typically structure as interest only with the balloon payment at 10 years. The interest only payments will be ordinary income. Mm-hmm. The principal balance will be capital gains tax. And as long as they don't touch any of the capital gains tax, they're just going to pay ordinary income on the 8%. Okay. Remember, we're saving that 1.1 million. Yep. So in this scenario, instead of having 2 million after tax, they have 3.1 million working for you. So you want to think of it like a interest-free loan from the government. So Scott, if the government says, Scott, I'll give you 1.1 million as a loan here, but you got to put it all investment purposes. It's got to be in a business. It's got to be in, hard money lending. It's got to be in stocks, bonds, mutual funds. And for as long as you want, Scott, as long as you don't touch any of that principal of that full 3.1, you just live off the interest. How long would you keep that note going for?
A long time.
We call it the second day to never. Okay. By the way, there's a reason the government does this. Okay. For those of you thinking, oh no, this is too good to be true. It's got to be, it's a study of macroeconomics. Okay. Which states if we can keep the money moving and flowing, we're actually incentivizing deals to go, and we're actually incentivizing, as long as the money's invested into business purpose, more economic growth. And more economic growth produces more jobs, and more jobs produces more tax revenue. It's the same reason they allow a 1031 exchange, is the reason they allow this IRC 453, which, by the way, is the installment sale, or is the IRC tax code, which is installment sale tax code, that this is based upon. Okay. So 10-year notes, you can renew them whenever you want and just keep going. But here's the cool thing. Scott finds this apartment complex over here, okay? And this apartment complex, let's imagine it was worth $5 million in 2020. But after COVID-19 and everything hit the fan, a year later, it's worth $4 million. Mm-hmm. So had they done the 1031 exchange into this $5 million deal, guess what they just lost out on the opportunity cost? That $1 million discount. You follow me, Scott? So what we can do is we can fund this LLC. You have up to 80% of the 3.1 million can go the next day into this LLC. But let's just use 2 million for right now, okay? And you go and buy this $4 million deal at a discount. You put a 50% down payment. So not only did you buy at $1 million discount, which you're happy about, but you also got what's called a brand new depreciation schedule. So the 1031, your depreciation schedule travels. Depreciation is one of the number one reasons to own an investment in real estate, because the income that comes in gets offset by the depreciation. However, if you own long enough, you've done multiple 1031 exchanges, the depreciation schedule travels, which is not good. That means you have a lower depreciation schedule. The intent is to get a brand new depreciation schedule. Well, you can't do that with the 1031. The solution is the Deferred Sales Trust. So with the DST, what's amazing is because we structured it in this way, and it's a brand new LLC, and you did what's called a JV partnership with the LLC, or guess what, Scott, you're the managing member of this. So you're back to owning real estate the same way you were before, except you just did this extra twist here. This $4 million is a brand new depreciation schedule, of which, of course, you could do cost segregation on that $4 million, and this can offset this 8% that's paying it, plus any of the cash flow that this deal is producing. I'm going to pause there. Any questions on that, Scott? Because that's really important.
Yeah, we got a couple questions that just popped up here. Let's see here. Nathan asks, to utilize the DST strategy, is there a minimum floor for entry or cap on amount of assets that be placed into a DST? And then are there any limitations on types of assets that can be placed into it as well?
Okay, so the minimum is $500,000 of net proceeds. And we also need to make sure we're deferring at least $100,000 of liability. So that's the first thing. If your deal, if you have one deal, one-off deal, and it's only 500 and 100, then you're good. But if it's below those numbers, and this is liability, this is not gain, okay? This is the actual check you're writing to the state, federal, depreciation recapture, and Obamacare, which is how we get somewhere between 30 and 50% depending on what state you're in, okay? So if all of that is greater than 100,000, the actual check you're writing, and your net proceeds from the sale, net of all closing costs, is 500 or greater, then that's our minimum, okay? What's cool about the deferred sales trust, though, is you may have asset number one, real estate, business. Let's say you had some Bitcoin that hit the roofs. Let's say you had an artwork. You have one trust, and we call it multiple notes. Okay, so it started at 3.1 million, and then you added another million, and then you added another million, another million, another million. So now all of a sudden you're at, let's say that's 7.1 million. And you're consolidating all of these assets into this trust, and you're paying off all your debt, and you just keep piling the money up. Or let's say there's some people we work with, they have 20 homes, right? And the challenge with selling 20 homes is, well, how are you going to do a 1031 exchange with 20 homes? Well, you're going to have an investor. You have to pull them all together. And the investor is going to buy it. But guess what, Scott? He's going to want a 30% discount. Your intent would be to sell each home to an individual buyer who's a homeowner who can get FHA financing and put 3% down and buy this property. And guess what? You're going to get a 20 to 30% increase on that. The challenge is you can't do a 1031 because you can't time all of those together. But the intent is to defer it. So you feel trapped again. You feel trapped. Well, what do? Well, you just slowly roll each house as you sell them. You have total freedom just to sell slowly, one at a time, and you just keep consolidating into the trust. Okay, and eventually you get this big pile of money, and guess what you can do? Go buy that apartment complex, right? Or go buy whatever. That makes sense? Does that answer the question?
Does make sense. Wayne Brinson asked the question here is, can you recap? Because if you sell it to the DST, doesn't that trigger capital gains tax? Yeah, I must be missing something. So just, I think Wayne just a few minutes late.
Let's go again. Let's go again.
First part of that.
Yeah, let's say it's a $3.1 million asset here, okay? But instead of receiving the cash, they're going to receive a note. They're going to do 100% financing, okay? So they just had a seller carryback. And they carried for the trust. They lended the money to the trust, okay? And instead of the cash buyer paying them, nope, we're going to have the cash buyer put the funds into the trust. So the funds are just sitting right here, okay? And just think of it like a 100% seller carryback. So if someone came to you, Scott, and said, I want to buy your property, and you had a zero basis, and you owned it free and clear, and you go, I'll carry back 100% paper. Well, you didn't receive any money. Therefore, the tax is not triggered. It's in a deferral state. By the way, it's the same way a 1031 works, Scott, right? What do? Well, if they want to do a 1031, they say, don't send the funds to the buyer, send the funds to the 1031 company to maintain non-constructive receipt, right? And then what happens? You take that and you go buy the property over here. And then you sell that property and you move the funds back into the QI company. And then what do? You go buy another property over here. So the key is this 3.1 million is never going into your personal hands. So we're kind of like a 1031 company, right? We're kind of like you can kind of call it your own personal deferred sales trust 1031 company. If you think of it like that, right? We're kind of like that, where you're just kind of parking there, but none of the restrictions and none of the 1031. By the way, 1031 is IRC 1031. That's the tax code. We're RSC 453. So they're both tax deferral strategies. They're just separate tax codes and they have separate rules. Is that making sense?
Got a question here from online on Facebook on the live stream. Is this something we can set up right before closing, or is there a time frame? And forgive me, I know you probably got the timing of this in a little bit later, but what do we have to have set up before closing?
Depends. So if it's, let's talk about a commercial real estate property. Okay. You're okay as long as you go, with the QI company that will allow you both options. Okay. So you need to get with us early. You need to connect with our 1031 companies early. And you need to make sure that you have the deferred sales trust language early, okay? So we've done deals in a week, a couple days. But we need to make sure that all contingencies are not removed, A, or B, you're with a qualified intermediary, we'll give you both options. Not everyone's the same, okay? So make sure you get with us. That's the first one. Now, if you're not selling commercial real estate, you're selling a business, you're selling a primary home, you're selling artwork or collectibles, then we need to be in there before close of escrow. And we need to be in there early, okay? We need to put the language in there, okay? So reach out to us and we can walk through your specifics, but the answer is be there early, okay? So who does this work for? Let's keep moving here. It works for, again, the business owner, the primary homeowner, car dealerships, tech entrepreneurs, dentists, veterinarians, optometrists, collectibles, artwork, investment real estate. It works for the real estate developer. The funds can be used to develop real estate. It works for the commercial real estate syndicator, the operator. It works for carried interest. All types of high net worth clients, this works for. These are a couple guys. This is Steve, John, and they sold their multifamily property. In fact, I actually represented them and I sold this property for them, $270,000 per unit. Now, Scott, is that a crazy price for a flat roof, 1960s downtown, midtown property in Sacramento? I think it's pretty high, right?
I would say it's kind of high, but that's California. Who knows, right?
Yeah, it was about a 4.3 cap on these maxed out rents. And so they made a great sale. Well, guess what happened with it? It was challenging. John had a family emergency, so he had to bail out on the 1031 exchange. And Steve was left, looking at a 1031 exchange that was a 4.3 cap and taking on a bunch of debt. And this is before Corona crash. And he's going, I can't make sense of this deal. Well, guess what? This saved Steve's failed 1031, and John was able to go his separate way and do his own deal. And because of the Deferred Sales Trust saved them. This is another business sale. This guy's a transactional attorney, and he's in Las Vegas, Nevada. Really smart. He did the Deferred Sales Trust for the sale of his business, okay? So these folks are asking tough questions, and they did the due diligence, and they did the deals. This is a Google executive. She sold her high-end primary home in Cupertino, about 3 miles from Apple. And she had this huge house. And guess what? The primary home does not work for a 1031. So she sold her $3.1 million house and went from owning this big property with all of this debt. And she didn't need the house. All her kids are gone. And she's just sitting on this house. And she's like, well, if I sell it, I get hit with about $400,000 in tax. So I can't use a 1031. So she felt trapped. And so she got out of debt. She paid off her debt of $1 million. She deferred all of her tax. And then what the cool thing is, she took what we call a primary home. It really is a liability to us because it's not cash flow producing. She took a liability and she moved all of the equity into cash flowing producing assets. Okay. So she's really happy. A few other recent closes. These are just some big ones that have closed, and then some other ones that are under contract right now. So again, we're looking for, people that we work with are looking for transformation, not just a transaction. Okay. And by transformation, we mean complete debt freedom, okay? We mean completely tax deferred. We mean your wealth being diversified. Your wealth also being liquid, okay? Liquidity is very important, we think, right now in this crisis that we're going through, and it puts you in a really strong position. No more toilets, no more trash, no more liability, time to enjoy your wealth, and then the opportunity to grow your wealth, because maybe you're saying, Brett, I'm not older, I don't want to retire, I'm not a baby boomer. That's fine. Look at it as an opportunity to grow your wealth by just timing the real estate market. If you knew this back in 08 or even before Corona, right? Imagine you knew this in 05, 06. What would you have done? Even if you didn't know about this, you would have sold everything in 05 and 06. And you would have paid all of your capital gains tax. And you would have sat on the sidelines and you would have bought real estate at 20, 30, 40, 50 cents on the dollar without this. What we're saying is you can do the best of both worlds. And this is why we believe it's the #1 way for you to grow your wealth, because we know when it's a buyer's market, Scott. We know when it's a seller's market. In real estate, it's like a big ship. The ship takes a while to turn, right? The stock market can turn on the dime, but the real estate, we're like, oh no, boys. We're looking out and we see there's some big things ahead. It may take 6, 12, 24 months, but we know it's shifting. We know it went from a seller's market and it's coming quickly to a buyer's market. So this is where we give you transformation in your wealth plan. Is that making sense, Scott? Or any thoughts on that?
It does. We got a question from Todd Silverstein on that last example you gave from the Google executive who had the $1 million house or the $1 million mortgage in the house. Todd asked, what happens with the debt on the property?
Yeah, it just paid off at the bank. So at close of escrow, it's just a closing cost. So as long as your mortgage is not above your basis, okay, there's no issue here at all. If the mortgage was above the basis, then there's we call that boot, okay? In her scenario, her mortgage wasn't above her basis, so she just pays off the debt, and so the note is just the difference between that. So
right. Okay.
Yeah.
And he goes, where did the $1 million come from? Because they financed. She sold her. I don't know what the price of the house was that she sold on that.
3.1 million. I'll walk you through it. Yeah, the buyer bought the full amount. So what we asked the buyer to do is to bring all cash or get a loan. Like, we're not going to finance you, okay? So bring the full 3.1 million. So they bring the full 3.1 million to the deal, but instead of buying it from her, they're going to buy it from the trust, who buys it right before close. So it closes it and sells it. And then that 3.1 million goes into the trust minus the debt, pay off the debt over there. Now just the remainder. It's about 1.8 or so, 1.9 that went into the trust. So so the key is the cash is coming from a buyer. We're just going to find a buyer over there, and we're going to ask them to cash us out, either all cash, bring a loan. We don't care how you bring the money. Just bring it all to that closing.
That makes sense. He's got it now. That makes sense. Because then the 2.1 sitting in the DST waiting for whatever she wants to do with it at that point.
Exactly. Yep. So how do we know this thing is legal, and how do you know your funds are protected, right? Those are some of the most important questions, okay? You should ask of anybody who's bringing you a brand new tax deferral strategy, such as the Deferred Sales Trust or anybody else, okay? First thing is track record, okay? Thousands of closes and also 14 no change successful audits, okay? Scott, if you and I got audited right now, what are the odds that the IRS wouldn't find one little thing to change, right? Probably, you have to find something, right? We missed a receipt, or we missed something here, or it was an extra 500 here, or whatever, right? They're gonna find something on an audit, and we're gonna change that. No big deal. We're gonna pay the difference. Okay, great, IRS. Well, guess what? The IRS is looking for any holes in this thing. The biggest deal was a $125 million deal in San Diego. Guess what? No change audits. Not one single issue. In fact, they just looked at it and said, you guys are just doing an installment sale. You're being pretty creative with this third-party trustee, which is, by the way, that's our role with a third-party unrelated trustee. Unrelated party can't be a family member. In it for business purpose, yep. The funds are invested for business purpose, yep. Continue as you are. Not one change in 24 years. So you want to make sure that whoever you decide to burn the ships and go with a tax deferral strategy, that A, they have the track record to back it up, and also B, they've had actual clients on actual deals that they've closed have an IRS audit. You don't want to try someone who's new, just been around for a couple of years, and hasn't been tested by the IRS. If their answer is, oh yeah, no, we've never been tested by the IRS, that's not good. You want them to go through the fire with the IRS. So step number one is track record. Step number two is, well, what happens if I do get audited? Well, you want whoever who's going to defend you, not only have they have the successful wins against the IRS, but they're going to provide the audit defense, and they're going to pay for it. So as a part of the one-time fee to the tax attorneys, they have what's called lifetime audit defense, and they also indemnify you as the client. They stand behind their work. Step number three, you want to make sure the funds are protected, okay? So we set it up with the bank account, a large bank, and it's called Direct Access Control Agreement. It's known as a DACA account. The funds only move with your signature. So you ready, Scott? If you sold your property today, Scott, and paid millions of tax, and you walked into this bank and you put the funds in there, do the funds move without your signature?
Nope.
The answer is no. Now, Scott, if you sell and use the Deferred Sales Trust and defer millions of dollars in capital gains tax, do the funds move without your signature?
Nope.
Exactly. It's the same exact protections, okay? And we have DACA in place, which is great. And so that's there. Very safe. All right. So that's secret number one. We're moving to secret number two. And I know we're probably going to run out of time. Scott, how much time do we have?
You're good, man. You're good. It's Monday night. You have till you're done.
And there's no Monday Night Football going on, right? I mean,
yeah, I know, right?
Only like the replays.
We're good.
I was watching the Super Bowl replay, by the way, Kansas City Chiefs beating the 49ers. I'm a 49er fan. I was watching it yesterday, and my heart was breaking all over again. So for any Chiefs fans out there, I applaud you, but I'm a 49er fan. But what I thought was so funny was they were just skipping the 49ers drives. They were just like, there would be like certain drives would be back and forth, and all of a sudden like Niners would get a stop in like the third and fourth quarter, and they would just like skip the Niners doing a drive, and they just go straight back to the Chiefs. I'm like, what is this? This isn't a replay. This is a victory dance for the Chiefs. Anyways, I digress. no Monday night quarterback or no Monday night football right now. All right. So number 2, deferred sales trust, optimal timing, and wealth plan. So how to clone a proven wealth plan with capital gains tax solutions. Our team, okay, because it's not just the transaction, it's actually the team that you work with to execute the business plan. It's sort of like, Scott, you buy an apartment complex and you're in Texas and you buy it in, I don't know, Ohio. Well, guess what? Scott's not going to be there every day. And guess what? He's going to have to find a team to execute the business plan that he bought on this great $4 million deal that used to be worth $5 million. Same thing here. You need to make sure you're working with experts who you can clone, who've already have a proven track record, who you can basically clone the wealth plans of their clients, and of course modify and adjust it and customize it to you. But we've already done all that work. We've had the thousands of closes, and our tax attorney is brilliant, and the financial advisor we work with is brilliant. By the way, if you want to use your own financial advisor, bring them in. We have thousands of financial advisors across the U.S. They sign up with us. They do a fee split, and it works out great. Okay, so let's walk through all that. Sell, fund, and invest. Hey, Scott, when can you sell, fund, and invest with the Deferred Sales Trust?
At any time.
Anytime, my friend, anytime, okay? That is the plan. Sell high, buy low. We keep it super simple. Sell high. Scott, you have some notes to invest in at 8, 9, 10, I don't know, 12, 15%. Okay, let's put some over there because now is a good time to lend. It's not a good time to be an owner, but it's a good time to lend. Okay, great. A mobile home park investment, that's a better part of the country. Great, let's do that. Anytime, sell, fund, and invest, and then vice versa. Of course, if it's in real estate, we're going to have to sell out of that real estate deal and then put it back into the trust. But this is the plan, and we just keep it very, very simple. And you may find the deal tomorrow. You may find the deal the next day. But hey, we're here for you too to help you vet these deals. And if you need trusted operators, we have those too that we've already vetted. And we only recommend and invest with people that we invest with personally. Okay, so that's another thing. But it's up to you. You can just do all the deals yourself. You may say, like, I don't want to do any deals with anyone else. I'll do it all myself. No problem. Do it all yourself. You can do that too. Okay. All right, step number 1, you need to map out your wealth plan. We already talked about that. So you're going to envision it first, and then you're going to map it out. And I say me, Rod, and your trusted financial advisor. Don't worry about Rod, but it could be your trusted advisors. It could also be the financial advisors that we provide. But we're going to map it out of simply what is your risk tolerance and where is this allocation going to go? Okay, so let's all sit down in a room on a Zoom call or with your CPA, your financial advisor, and let's map it all out, okay? And step number 2 is you're going to sell the asset, okay? You're going to sell the property. Pretty simple. Step 3, you're going to fund the trust. Very simple. 24/7 access to view the funds. And then step 4, enjoy your wealth and give more. This is like the achievement, okay? As a quick overview again, they're 10-year notes, okay? So it's just an installment note of which you can renew every 10 years for 10 years. Typically, it's an 8% earning target, meaning net of fees, Scott, net of financial advising fees, net of the trustee fees, net of the bank account fees, the tax return fees. We'll talk about all that. By the way, our fees are typically 1.5% on an annual recurring basis, but we're hoping to out-earn those fees. Ideally, we earn 9.5, 10. Can't guarantee it over a 10-year period of time. And then you net a target rate of 8, which is pretty good. But on a cash flow, just on like a year-to-year basis, most of our clients will just go 6.5%. They want to keep that principal intact. Remember I talked about not wanting to pay the tax second day to never? Well, we keep the capital gains tax all deferred, and you just pay ordinary income tax on the interest that you're receiving. But most folks want to keep a little gap between the 8 and the 6.5 just to make sure we're not dipping into principal. You say, well, Brett, what if I need more? No problem. What if I need 10 or 12? No problem. This means you're going to dip into principal a little bit along the way. And if you do, you'll pay some tax, which is no problem either, right? It's up to you. It's your money. How do you want to structure the note? It could be amortizing over 30 years, over 20 years, over 10 years, over 5 years. It could be, again, interest only, and then a 10-year note, whatever you want. And also, you can adjust it along the way. So, Scott, you might start out saying, Brett, I actually don't need any right now. Let's keep it deferred. Let's let it just compound. And then in a couple years, let's start pulling off of it. You can do that too. Okay, renew for as long as you want. cash out whenever you want, just pay the tax, and then also pass it on to your kids. It passes inside of your living trust, and your kids can inherit your position and they step into your shoes, or you can give it to charity, right? But guess what? We're not like a CRT. We're not forcing charity. In fact, you can put 10%, 20, 30, 40. You can direct the payments to charity, and then you can adjust along the way too. So we give you some more freedom and options there. It's totally up to you. So what we used to have to do, what we used to have to do, stay in our primary home, feel trapped in this big old home that has all this equity, and maybe do a reverse mortgage, or maybe try to rent it out for 2 years and do all this stuff. Not sell our business because we couldn't find a tax deferral strategy that worked. Overpay for a 1031 property, right? More time, energy, toilets, trash, tenants, employees, and liability. We used to have to become the lender, do a traditional seller carryback for a single buyer, okay? So this goes to the part of, well, Brett, why don't I just do a regular seller carryback? Like, why do I need to pay these fees and do this thing? Well, what is traditional seller carryback? If you do 100% financing, first of all, you're not going to do that because it's that person has no skin in the game. And your collateral is tied to that person and that asset, okay? So you're basically not diversified. That person is not investment grade. Your asset is not investment grade, right? And your eggs are all in one basket. You may have to foreclose and take that back. Also, traditional installment sales are typically short in nature, 3 to 5 years, with no prepayment penalties, and then you're just paying the tax anyways. So there's really zero advantage to doing a traditional seller carryback versus the deferred sales trust, which has, you go on forever, you can completely diversify, you're not counting on that property ever again or taking that business back. You can put it in investment grade securities. You have the ability to have liquidity. So that's why it's better than the traditional installment sale. Or you can also stay in debt and do a 1031, but it also takes up more time and energy, or pay the tax. Nobody wants to do that. So again, a new way, a better way, and is the deferred sales trust. So with all that being said, I've been a big introduction to the deferred sales trust. Who here thinks the deferred sales trust is awesome, is amazing, is mind-blowing? Boo, it's probably still too good to be true, right? Your brain's still pretty exploding. But if everything I've said is true so far, Scott, do you think this thing is amazing or what?
Yeah, that's why I have you on here. I'm expecting us to see a bunch of deals come across the board, or working. This is another way of looking at it too, is thinking about people that are scared to sell or carry, or don't want to sell their house because they're afraid of the capital gains tax. So like I'm marketing to self-storage owners that have owned their property for a while. They've got some equity, even in a little bit of a downturn, are probably like, oh no, I don't want to pay the taxes. This is a great way to educate them to find a way to help them solve their biggest problems on an asset you may be looking at buying.
Yes, right. And also they can capture that value at the height of the market, right? Market goes in swings. So why not capture the value now, get out on the sidelines, diversify, wait for that deal to come, then buy it low again, ride that wave up again, capture that value, rather than just sitting in these big market swings in your single asset class, in your single location, in your single product type. Diversify, get out of debt, get liquid. Do we have some questions that popped up? I saw a couple things there. Click.
We got something pops up. Wayne never heard of an alternative to 1031 exchange. Todd is asking the question, since when did a 1031 exchange start having a reputation overpay for an asset? I've just got done with one, and it was listed for $4 million, worth 4.3, and purchased for 3.6. You want to talk about that a little bit, Brett?
Yeah. So every seller's market, buyer's market is different. So back to my story in 2008, I saw friends, family, and clients lose everything because in 05, 06, 07, they had overpaid for 1031 properties just to defer the tax, just for the market to fall apart, and then lose everything. So that now, is that going to happen right now? I don't think so. I don't think COVID-19 is going to be an 08 crisis all over again. And you wouldn't want to make these decisions based upon fear. However, we're going to walk through how this deferred sales trust is going to be an investment, not an expense, here in secret number 3. But you have to ask yourself, is this a seller's market? Is this a buyer's market? Do I want to be in right now? Where do I think the market's going to be in 3, 6, 12 months? Do I think it's going to be more of a buyer's market? Do I think there's going to be more opportunities? And I would venture to say that you ask 90% of the commercial real estate world right now, and they would all answer those in the affirmative for wait and see. There's going to be more opportunities. Deals are going to be lower priced, right? So, but that's up to you, right? And by the way, if you can find a deal, by all means, do a 1031. and you don't mind the management, the toilets, the trash, the liability, the debt, any of that, go for it, right? If the cap rates make sense. Here in California, we just have seen deals at like a 4 cap, right? And you're borrowing at 4%, and the rents are through the roof, and there's not a lot of value add. There's not a lot of forced appreciation, right? And you're competing against all these buyers. And another way to put it would be this way, Scott. I would say, would you buy the property if it wasn't for deferring the capital gains tax? Just imagine it was not there. Imagine you didn't have to do a 1031. Would you buy that same property today based upon the intrinsic value, the location, the value add opportunity, and the cash flow? And if the answer is yes, then by all means, buy it. Just don't let the tax determine whether or not you buy a deal. Let the intrinsic value of the real estate and the opportunity and the business plan determine that. So that is completely up to you. But by the way, we are a backup plan for a failed 1031. We don't take up any of the 3 spots. So the worst case scenario is you go out, and we don't charge anything for that either, by the way. We only charge if and when you close the deal. So so at least you have it as an option. You're working with the QI company who's giving you that backup plan. I got a call today, a gentleman who it is a 2.6 million in the QI company, and he needs to buy something for 4.6 or greater. Well, guess what? All 3 of his properties that he had identified for his QI, all of them failed. And now he's just left sitting there going, what do I do? So we're going to save his failed 1031, right? So that's at least. But again, if you can find a deal, hey, I love investment real estate, go for it. Does that answer the question, Scott?
Yeah, that makes sense. Yeah, exactly.
Okay, cool. All right, so secret number 3, how to get your deferred sales trust to work in your favor and become an investment and not an expense, okay? And this is what I call the wealth building hack. It's another way to put it would be how to get the deferred sales trust to work in your favor and be better than a 1031, right? This would be another way to think about it, okay? So first of all, step number 1, net income tax advantage, okay? So we're gonna do a side-by-side comparison. Imagine, Scott, you make $400,000 a year, okay? And $200,000 of that income is from your investment property, okay? And that investment property is producing that cash flow, and it's putting you into a higher tax bracket, okay? And if you look at these tax brackets here, it's pushing you, let's say you're married filing jointly, into the 35% tax bracket. Okay, you see that? Or even 32%, okay? So guess what? If you were to sell that investment property and do a 1031, your cash flow may be the same or close to it. Meaning you're staying in the same tax bracket. But Scott, you may tell me, Brett, I don't need any of, I mean, I need about 150, but I don't need the 400. So the intent would be to lower your income tax bracket and wait to receive that income when it makes sense. So what can we do? Well, we can sell that asset. Instead of doing a 1031, we can move it into the deferred sales trust. And then the cash flow that it's producing, guess what? Remember how I said we can structure the notes as no interest payments? I mean, it could be interest only, but it could also be nothing, no interest, and then a balloon payment. Well, we can do that. So for 2, 3, 4 years, no payments at all. Meaning that extra $200,000 that asset was producing is just compounding on top of the trust. And so your income drops. It drops down to the 24% bracket. Okay, you following what I'm saying here, Scott? I can't hear you if you're talking. You might be on mute. Hello, hello. I can't hear Scott, so I'm going to keep going. So we call
it
this
helps if I hit the mute. It helps if I don't hit the mute button.
There you are. Yeah.
Well, as I was saying, based on your analogy, there is if I drop my income, so making over 400 grand and paying 32. If I said reduce it in the year that maybe my income falls to say 320, I could still take up to 75, 80,000 there to avoid paying a higher tax bracket when I needed to pull that from the DST. Right? You
got it. We call it tax engineering. You receive it when and if it makes sense for you. You even may move from California to Texas or California to Nevada or New York to Florida, right? You relocate and you establish residency there. And then you start pulling it in, right? So it's your money. How and when would you like to receive it? The 1031 doesn't give you that option, right? This does, okay? So that's number 1. This is how it becomes an investment rather than an expense and why you would do it over the 1031. But again, let's draw that line down the middle. Let's figure out what your income is. Let's create this wealth plan, and let's see if you can take advantage of the net income tax advantage. Quick sample. So 440 in income, 200,000 from a business goes into the DST, right? Instead of keeping that business, you sell it, and then you allow it, that 200, to compound on top of itself. And now your tax bracket drops to 240. And so you just save $70,000 in tax. And then guess what? Let's say you retire in 3 or 4 or 5 years, and your other 240 that you were earning goes to zero. Well, now let's start pulling on the trust. Okay. In the meantime, it has built up. So it's kind of like a 401k in that sense, Scott, if that makes sense. I'm putting it into a tax vehicle until a later date, but we have none of the penalties. If you pull it early, of course, you'll pay the tax on whatever you receive in the given year, but we have none of the like the 10% penalties that the 401k has. Does that make sense?
Yes, it does.
Okay. Step number 2, okay, of why this is an investment rather than an expense. So for any of your ultra high net worth individuals, okay, who are listening to this call, and for those we're talking about worth more than basically 23 million or 22 million married and about 11.58 single, okay, you're probably challenged with what's called the estate tax. It's also known as the death tax. Okay, so let's do a scenario. Let's imagine, Scott, today you're worth 52 million and you're married. Let's imagine all of it's inside your taxable estate today. Well, guess what? That first 22 million is exempt. It's actually 23.16, but it went up for 2020. These are 2019 numbers. But that 30 million that's above and beyond that 22 million, Scott, is going to be hit with a 40% death tax if you do not move it outside your taxable estate. Now you say, well, Brett, I have the stepped up basis. I can just 1031 and die and get the stepped up basis. Well, that's one of the biggest misconceptions. The capital gains tax is not the estate tax, okay? Capital gains tax is capital gains tax. So true, you could hold on to a property, get a stepped up basis, and then if you die, your kids get that, okay? And they can walk away capital gains tax free, but it has nothing to do with the estate tax. So again, we're gonna draw this line right down the middle for your wealth plan. And we're gonna say, keep going with your 1031 exchange plan. And keep doing that. And what's that going to mean for you? Well, if you do on this thing, it's going to mean a $12 million estate tax. So the intent is to get it outside the taxable estate. The challenge is you can't get it out fast enough, and or you run out of gifting. So most high net worth individuals, before they find us, they go, look, we've done gifting, we've done family limited partnerships, but we can't get it out fast enough. In other words, they run out of exemptions per year. So the solution is the Deferred Sales Trust. We, in a single transaction, we call it the DST Plus. We can sell, let's imagine it's a $30 million deal, Scott, and move all of the funds, all of the equity outside of your taxable estate in one single day. And we're doing a deal right now in San Francisco. The couple is worth $126 million. They've moved $26 million outside the taxable estate. They have $100 million left in the taxable estate. And they're selling a $20 million business. They have a zero basis on that business. And so not only do they say, hey, we're baby boomers, we want to retire from all this, but second, we're owing $8 million in liability. We can't get this thing out fast enough of our estate. And we have another $7 million capital gains tax. So not only are we going to defer the capital gains tax, but in one single deal, one transaction, we're going to move all of that $8 million outside of their taxable estate. So I'm going to pause there, make sure you captured this, because this right here, I think, is the best kept secret for the Deferred Sales Trust as it pertains to ultra high net worth individuals. You still there, Scott? Maybe you're on mute again.
I'm still there. Yeah. You can't hear me shaking my head. Yes.
Okay. Perfect. So make sure you caught all that. Okay. So that's big. All right. So moving on to step number 3, the seamless partnership separation. So in a 1031 exchange, it's challenging to separate a partnership. Why? Typically, the whole entity must move. What does that mean? Well, if Scott and me and 5 others were in a deal and we bought it in an LLC and we owned it, well, if we sell, the way the exchange laws are set up, the whole entity must move, meaning if one of us tries to drop out or one of us gets out, the whole thing fails. Now, there have been some drop and swaps, and there's some creative ways, but most of the folks that I've worked with, they kind of shy away from those things, and it's becoming more and more restrictive. And or maybe just the partner doesn't want to do it. Maybe the partner says, Scott, I don't want to do another exchange. I want to get out. And the other 3 partners are like, we want to keep going. And they're fighting over selling or buying and tax. And well, guess what the Deferred Sales Trust allows you to do? If there was 5 partners, Scott, and 2 people wanted to pay the tax, they can pay the tax. 1 person wants to do a 1031, they can do a 1031. The other 2 want to do a Deferred Sales Trust, they can do a Deferred Sales Trust.
Wow.
It's a seamless partnership separation. In other words, we don't have to follow the 1031 guidelines. Okay. Very powerful, really helpful because they're saving a bunch of tax.
Wow. It's huge.
Step number 4, invest. And this is just the biggest one. I just got to go back to it. Invest in real estate. And it's really the advantage of no timing, purchase at a discount. And then you combine the new depreciation schedule. Remember I mentioned that before, with the cost segregation. And that's another part of the ROI, where you look at, if I just trade and do a 1031, my depreciation schedule travels, meaning I don't have as much depreciation. But if you bought that same deal with your deferred sales trust, guess what? It's a brand new depreciation schedule. So commercial real estate is 39 years. Apartment buildings is 27 and a half years. So if you're fully depreciated or close to it, look at the deferred sales trust to get a brand new depreciation schedule. And then use cost seg on top of that to wipe out all of the income that the asset's producing, as well as the trust that's producing. And or you might just say, look, I'd rather be debt-free, and I want to invest with multiple commercial real estate syndicators. I don't want any of the debt in my name. I don't want any of the headaches. I don't want any of the toilets or trash liability, but I love investment real estate. Great, let's do that. If it's a $10 million trust, $8 million can go out to commercial real estate deals. You can maybe choose your top 8. The other $2 million needs to stay liquid, diversified, investment grade securities. And of course, the 1031 exchange alternative or rescue. So this is Peter. I want you to meet another client of mine. And his biggest quote was, Brett, I had 18 units and it was 18 problems. And I didn't want to trade 18 problems for 36 problems. I was tired of the toilets, the trash, the liability. I almost lost everything in 2008. I had all this debt and I'm driving 2 and 3 hours, 2 and 3 days a week from Marin, California. It's north of San Francisco to Sacramento. He's banging on doors, trying to collect rents. He's trying to hire a property manager. He's just tired of it all. And he's like, look, it was a lucrative investment, but it took him a lot of my time and energy, a lot of headaches. And so for his scenario, he actually sold for $1.8 million. He paid off about $500,000 in debt, and he put $550,000, he deferred $550,000 in taxes. And he goes, I've never had so much time and energy, Brett. He goes, I'm so happy I found this. He goes, I looked at Delaware statutory trust, but I had no liquidity. I had no control. He goes, hey, I may want to get back in the game when the deals make sense, but not right now. And so at 8%, that's an extra $44,000 per year. So it's not just the external motivation of capital gains tax deferral, it's the internal motivation of being able to have freedom, time, energy, right? To not have to worry about rent control, toilets, trash, liability, right? And then to go back into real estate if and when he wants to, which is his plan as well. By the way, he's a long-time real estate broker himself. He's been in the business for 35 years, and this is the first time he ever used the Deferred Sales Trust. So we covered the 3 secrets, and we're going to wrap this up here fast, okay? We covered, selling and deferring hundreds of thousands to millions of dollars in capital gains tax, how to legally break free from capital gains tax and find freedom to buy and sell your business or property without ever worrying about a 1031 exchange ever again. Secret number 2, how to clone a proven wealth plan in less than 5 hours. You can get on with us and your CPA and map this out over a weekend, and also not have to depend on a single income source and diversify your income streams. And also how to basically get the deferred sales trust and your wealth plan to start working in your favor and become an investment rather than an expense. Okay. So if what you did right now, if you just model, if you ask yourself this question, if I just modeled what works, okay, do you think you could do this, Scott? If you just set a call with your trusted CPA and attorney and with capital gains tax solutions and the attorneys here that we use to confirm this is legal and works, if you just did that, do you think you could do that, Scott?
Yeah.
Do you think if you just sat down with, I sit with Rod, but Rod's a financial advisor, but your financial advisor or the financial advisors that we have to offer and mapped out where the funds could be invested and where the risk could be accounted for, do you think you could do that?
Yeah.
And then if you sat down with me, Brett Swarts, we do a Zoom call, or if it's a big deal, I'll fly, wherever you guys are located. I just flew to Florida for a big deal. We can fly out to, but you could also, we can meet somehow, some way, just mapped out how the DST is actually an investment and not an expense for you. Do you think you could do that, Scott?
Yeah, for sure.
So let me ask you a question. You're probably feeling like this girl right here, right?
I'm sure some of the people on here hearing it the first time are definitely.
Oh my gosh, right? And it's just all this coming at you, right? So and it's so much information. You're trying to digest it and you're like, oh, my brain's exploding. When will he ever stop? Okay. Just give me a few more minutes. I just want to make you an offer. Is it okay if I just make you an offer, Scott? So you can see if I can help you achieve this. All right. So, first of all, I want to give you guys instant access to all the media and trading. Okay. I want you to take this at your own pace. And we're actually just launching Capital Gains Tax Solutions Academy. Of course, we have all the podcasts. We have the Escape Feeling Trap Guide. I want you to get all of that. I want you to listen to it. I want you to get educated. I want you to kick the tires, everything, right? Go to all these places, all these top people who have interviewed me and asked me tough questions. That's I think the first biggest thing is education. Okay. So I want to give you access to all of that and all the training. Okay. Plus, here's what you're going to get if you use the Deferred Sales Trust with us, right? First of all, you get we call it the white glove CPA tax attorney access. Bring your trusted CPA, and we hope to get their education and blessing. But also realize that they're kind of like the general practitioner. A lot of the CPAs we work with, they're great. They're smart, but they're in their own niche. Our niche is tax deferral. So we're like the brain surgeon, where theirs is more like the general family practitioner. But we want to get their blessing, but just realize when you bring them, they're not going to know about it, and they're going to be skeptical, and that's okay. We'll educate them along the way. But it doesn't mean we haven't done thousands of brain surgeries, and none of our patients have died, and none of our patients have gone to jail. So that's just something to really consider there. Bring your trusted CPA. Make sure they actually engage and get on a call with us and do the hard work of testing this thing out, and not just saying, I don't know about it, and I'm scared, or I'm what's the word? I'm embarrassed because I don't, and then just say no because I've never heard of it. Get them on with us and make sure we get them comfortable. By the way, 9 out of 10 CPAs and tax attorneys, they end up joining us. Once they actually see it and get to know us, they're like, oh, this is great. Not only does it work for my client and I give the blessing, but I'm going to roll it out to all my other clients. So that's the first thing you get, white glove CPA tax attorney access. Okay, second thing, transparent 24/7 access to view the account in real-time online updates. Okay, TD Ameritrade, online, all of those updates 24/7. Okay, you also get the DACA SunWest bank account. Escrow has all the funds all the time and ensures the funds are protected and only move with your signature. You also get the white glove seamless transaction coordination, where I'm, as a commercial real estate broker, have sold over $100 million, close to $100 million in commercial real estate. I am going to help transact and work with your commercial real estate broker, with escrow, with the lender, whoever, okay, along with the tax attorneys and CPA, okay? You're also going to get the professional banker direct access customer support. He picks up a cell phone. You can talk to him directly. A professionally prepared tax return service for your deferred sales trust with a 55-year-old CPA firm. We also have access to professionally managed value-add commercial real estate syndications with sponsors with a proven track record in mobile home parks, senior housing, retail, industrial, multifamily. Some of the top wealth advisors in America, IRS audit defense, lifetime indemnification, all of these things for you, estate planning if you need it. Okay, so who this works for again, primary homeowner, business owner, car dealerships, tech entrepreneur, business owners, anyone who's selling artworks and collectibles, anyone who does any real estate, anyone who's dealing with highly appreciated LLC, S Corp, C Corp, partnership, highly appreciated assets, Bitcoin, horses, you name it, it works for them, okay? So you can see why people are paying us, may pay us $100,000 to set up a deferred sales trust for them. You can see why the Google executive, why Peter, their longtime real estate broker, while Glenn, the transactional attorney, or Dave and Steve, they're paying us a lot, right? And I know this sounds too good to be true or too good to trust, but don't worry. We have a reference list, okay, client testimonials, and you can call them directly and talk with them. And then number 2, bring your trusted advisor to talk with us and get to know us. By the way, this is zero cost on our side. We do not charge you a thing unless and if you do the deal. Okay, so there's nothing, at this point, there's nothing you have to pay by just doing the homework and getting educated and bringing the people to here to test all this out, okay? But if you did the deal, we think the total value is, I'm just throwing a number out, $125,000. Of course, it just depends on the size of your deal and what this stuff means to you. It could be priceless, but you can get started today, right now, for 1.5% closing costs and an annual fee of 1.5%. You simply have to just call me, email me, and start your deferred sales trust. What does that mean? Well, the closing cost, 1.5% of the purchase price, and then there's an annual recurring fee, which includes all of what I just talked about, the financial advising fee, the trustee fee, the bank account bank account is actually $1,500 more. So there's a couple more, and $1,000 tax return. But our goal is net of all fees, besides the one-time closing cost fee, would be to net you 8%. So here's just a breakdown of a sample. With a $10 million sale, you could pay the 40% in tax. Imagine you had a zero basis, Scott. It'd be $6 million net, or you could use the Deferred Sales Trust, and this includes the first year fees as well. And you can net about $9.7 million. So that's an extra $3.7 million more to live off of, or to build more wealth. Again, 100% no cost unless you choose to use the Deferred Sales Trust and your deal actually closes. So you could do the homework, you could do the calls, you get it all going, and then for some reason the deal falls apart or you decide not to use it, no problem. We wish you well. You decide to go for your 1031, no problem. We only get paid if you actually close it on the trust.
Yeah.
So with that, I'll open up for questions, and thank you so much for your time.
No, it's good stuff there. Good stuff there, Brett. Definitely good stuff out there, because you're making people money out of something to be paying taxes on. I mean, that's the beautiful thing, and only if it's closing for the most part. What's you want to pull up your contact or your email for people to reach out to as well? Plus, you've got a lot of information also on the podcast that you've got you've launched.
Yeah. So real quick, we have let me see if I've got. I probably should just type it in here, huh? So email me
the previous slide, or no? I guess you didn't.
Brett at capitalgainstaxsolutions.com.
There you go.
Okay, and then it's Brett at capitalgainstaxsolutions.com, and then it's 916-886-2986, and then also we have we have our website, which is just capitalgainstaxsolutions.com.
That'll work.
So this looks a little funny here. But yes, please reach out to us and see if we can help you out.
And that's the thing too, is you've got, hey, let's jump on the phone. If you think this is going to fit, great. And that's why, honestly, it's not going to fit. This doesn't work for anything. Is not looking to defer at least $500,000, right?
Yeah, exactly. So the gain is over $500,000, right? And the liability is $100,000, right? Correct.
Yeah, there for everybody out there. What questions do you guys have for Brett out there, everybody? If you're listening or you're watching this on Facebook, we've got quite a few people popping in and popping out there for you.
And if I can also plug the podcast too, I remember if I can give everyone the link here, and if they like that, they can rate, review, and subscribe. We got this 24-hour period, Scott, where we're looking to boost the rankings.
Yeah, please do. Let's put that in the chat roll there. Definitely, actually, or I can email everybody out the link for that too, as well too, because Zoom has changed things now where it's not a clickable link, which is kind of a pain in the ass these days in the chat roll where it used to be clickable. So let me pull it up here. It might be easier for me.
I can email it too.
One of the great things too, Brett, is we see, obviously, kind of got a feeling, you and I've talked about this before, where we kind of see history replacing it, re-happening again, repeating itself like it did a few years back.
Right.
There's going to be a lot of opportunities out there, whether it's flipping and or taking properties down for a while, regentrifying, waiting for the market to come back up and sell off again on a regular basis. So you guys need to be aware of the things that are available for you. That's why we brought Brett on here to talk about this. And then I put a link into the website to get people to go directly to your website versus the Apple thing there for you. So keep that in mind. When you see opportunities, you're going to hear people like, oh, I can't take the hit right now. I don't have that aspect of it. Here's a way for you guys to find and make something happen, and have an advisor to make something happen. I mean,
and as a tip to that too, Scott, you got to figure out, if you're trying to buy from a seller, figure out what their pain point is, right? Yeah. And if they're older, they probably don't want to do a 1031, and they probably want to retire from this, but they don't know how to. So this becomes a solution for them. So just figure out, hey, what are you trying to do? What price are you trying to get, of course, and what's a fair deal? But what are you really trying to solve? Like, why are you selling? What's the motivation for selling? And then find a solution that fits their motivation, that answers their challenges, right? And if everyone you're calling to try to buy deals are just saying, hey, I'll just 1031, like they heard that from everyone else. They would have already done that if they had found a deal. But when you can bring something, again, it's not the Delaware Statutory Trust, because they're going to think DST, you can say it's a Deferred Sales Trust. It can be truly a solution for what they're looking for, and then all of a sudden they'll sell you the deal. So it's a good way to have it as a buyer as well as a seller.
Yep, exactly. Exactly. Well, Brett, I want to say thank you for coming on Note Night in America here on Monday evening on May the 4th. So honored to have you. Congratulations on the podcast. Thank you for sharing your insights on this. I'm excited about this, guys, because it's a vehicle for you to be able, if you're selling something, to be able to put your money into notes, whereas in a traditional 1031 exchange, you can't put that money into debt structures. You can't put it into notes. So think about it as you're out seeing deals and tapes and stuff that come across your table or your email or whatever like that. Here's a tool for you that can actually be really valuable for you. Wayne says, let's see here. Wayne asked a question. What is your typical split with a financial advisor? Is it part of your fee or additional? Wayne asks.
So we try to keep the 1.5% all in for the recurring fees. So that would include the financial advising fee, the trustee fee. Now there's a $1,500 DACA account fee, it's the bank account fee, and there's a $1,000 or so tax return fee. But at the end of the 10-year note, we're trying to net 8%. Okay, so net of those fees. So, which we think is pretty good, like 9. So hopefully 9.5, 10 is what we kind of earn over 10 years. And then you end up netting 8. Of course, you can renew for another 10 years and just keep it going. So hopefully that makes sense.
It makes sense. And that's only the part that you want to hold in there. That's not the part that you're going out investing using other things.
Right. And so immediately you can take 80% of it and go invest. And with the way we structure that is an 80-20 split, where 80% goes to you and 20% to the trust, even though the trust puts up 100% of the down payment. So it's a really unique way we do that. If you were just investing in notes, it would just be the return onto the trust itself because you're not getting any depreciation. But so yeah, it's a favorable deal. We try to make the fees and the expense and the upside as favorable to you as we can and be commercially reasonable with the IRS for the audits.
Yeah, Laura Blunk on here says, going to have to digest this before I know what questions to ask a little bit more. She joined us a little bit later, but we'll be listening to your podcast. Well, Laura's a great example. She's working on a very large portfolio right now of non-performing or performing notes of non-performing, depends on where they're at right now in the market being. But she were to look to try to sell that off, in a flip or a DST would be really valuable for her. If she's picking it up at 53 and trying to sell it at 80 because it's a performing, that's a big hit on the capital gains versus being able to put a DST in place to make it happen.
You got it. So we work for short-term capital gains, long-term capital gains, or is the 1031s only long-term? But absolutely. So we can defer taxes on the sale of a whole like a note, right? That's basically, you basically ran a business. You bought this and you sold it, and that business was that particular part of it. So LLCs, S Corps, C Corps, however you structure it, individual living trust, yep, it works.
Good stuff there. Any other questions from Brett before we let him get back to his lovely wife and your kiddos? I'm sure it's going to be about dinner time there, huh?
Exactly right. Yep.
Good stuff. All right. Well, hey, that's going to wrap it up. Brett, thank you again so much for coming out. Look forward to hanging with you and talking with you some more in the near future on some deals. All right, Brett?
Thank you. Thank you, everybody. My pleasure. My pleasure. Thank you.
All right. Make sure you go on out there, guys. Subscribe to the Capital Gains Tax Solution podcast. Listen to the episodes. Help us out with Brett helping on that launch as well, too. Make sure to leave a review and subscribe there to help us drive his podcast up for him here on.
And Scott's episode is dropping on Wednesday. He's the only one midweek dropping on Wednesday. So look for that one, too.
Thanks, man. I appreciate it.
Okay.
See you later, Brett.
Thanks, guys.
Have a good evening, everybody.